A very good afternoon, everybody. Welcome back to yet another edition of Netra. So we are here. We are not talking about anything that we have not talked about before, but we are trying to revisit some of them with a sharper perspective. Maybe a few topics that we'd be going through to just give you a gist. First, let's see what we're talking about. AI capex. We still don't know where the global AI capex boom could be headed. Yet we see Indian IT as a relative play. Second is gold. A lot has happened in this space already, and there's likely more to come. But if history is any guide, there's usually a clear pattern that follows a gold bull run, that is, a major economic downturn. But there's something else that could be winning here, and I'd leave that for Sahil to talk about more in detail. Lastly, there's rupee and our growth. Rupee, as you all know, it's sitting at lifetime lows. That is when dollar is not particularly strong, and underestimating this could be a serious mistake. And to top that, current growth trend is one of the weakest. There is no reason to celebrate an 8% real growth when our nominal growth is sub 9%. So this is basically just a gist. There's a lot more, and to dig deeper into all of that, I am going to hand it over to Sahil. Before that, a quick reminder, if you have any questions at any point, just drop them into the question answer tabs on your screen. We'll take them towards the end of the presentation. Over to you, Sahil.
Thank you, Pragati, and good evening to all of you. So we'll straight away dig into the DSP Netra for September. As you all of you know, we release this 5th of every month, and we try to put our thoughts together and speak to you every month. So this month, I think there are a number of important features which we are going to speak about, and it could be really interesting um, in terms of how some of these facts will come up and some of the questions that usually investors think about, but they are very hard to put in words. So we'll try to put those questions, and we've tried to put those questions as data points and present to you. So there are a few sections which Pragati spoke about. First, we'll talk about the driver of India's premium valuation. So usually, we've seen that people say, or a lot of market commentators say that India trades at a premium to emerging markets, right? Very few people asked why, right? And whenever there is this why asked that why India trades at a premium, some usual answers are narratives built around, um, the growth rates or GDP growth rates or demography or demographic dividend, democracy. um rule-based system, etc. But to our mind, I think all of these are just the enablers, or in fact, some of these factors don't even count. The most important factor is the profitability of companies. I think that is something which is unique in India. Also, only United States has been able to demonstrate it repeatedly, delivering very high, what we call return on equity. And that has been the case with India also. That is one of the reasons. So now I will showcase to you that where does this profitability come from and where it is right now. So if you go to the first slides on insights, it talks about why return on equity isn't higher. What does this mean? So if you look at the slide on your screen, you will find that um, return on equity back in one of the best bull markets in India, which is 2003 to 2008 period, was easily between 20 to 25%, a very high number. And that was one of the most profitable phases for Indian corporates. Also, if you remember at that time, earnings growth was also 20% plus. So it was really good time for corporate majors, one of the best bull markets that India has ever seen, bigger than what we have seen post-COVID. And uh, since then, in this cycle, valuations today are higher than they were in 2003 to 8 cycle. Second, earnings growth has been similar, 20% plus. Now it has come down, of course, but during 20 FY 21, 22, 23, and some part of 24, earning growth did have a CAGR of more than 20%. In fact, 5-year CAGR ending FY 25 was still 22% plus. So earnings growth has been similar or higher. Uh, then what is the reason for ROEs to get stuck at 15, 16%? Why we did not go back to high ROEs of 20-22%, right? Because if we were at 20-22% ROE and earnings growth, dips, let's say to 10-12% for some time, for 1 year or 2 years, the market should have been fairly priced. But that is not the case. Our return on equity hasn't gone up, although profitability has gone up. So if you break up return on equity, what generates return on equity? So if you break it up, you will find there are three levers. One is the net profit margin, how margins are moving. Second is asset turnover. How fast are you able to turn your assets? And third is the equity multiplier. That means how much leverage are you using on the same rupee of equity. So if you look at these three breakup of return on equity, you will find that net profit margins are already at lifetime high, which means that one of the three factors is very, very favorable. It is as favorable as it was in the 2003 to 8 cycle, or in some sectors, it is even better. Second is asset turnover. Now, this is very, very important. What does asset turnover means? I've written here that for every 100 rupees of assets, it generates about 150 rupees of sales back in 2003 to 8 cycle. Now, every 100 rupees of asset is generating 120 to 130 rupees of sale. What does this mean? Think about a business. How will a business grow? One is that the sales growth goes up. Okay. How will the sales grow? If, for example, if the product, let's say a company sells 100 pens and the price of each pen is 10 rupees. Assuming the price goes to 12 rupees, the sales will automatically go up, right? From 1000 rupees to 1200 rupees. Now, prices may not always go up. The other way for growth for companies to increase the number of pens it sells, or the volume growth. Volume growth will come when it is able to, what is in finance said, the sweating of assets, when it is able to use its assets more efficiently. For example, turning around its factory more times to generate more returns, right? Or to generate more volume. That is called asset turns. How many times are you able to turn your assets to generate more volume? That in this cycle has been lower, right? The other way to think about it is that if you want to have higher volumes, what is the best way to achieve higher volumes? Higher capex, right? So this is another important parameter which I will touch upon, that companies which do higher capex usually foresee more demand in the future. When they are doing less capex, that means they are not so gung-ho about the future, right? This is one reflection. But coming back to the ROE topic, margins are at all-time high. Asset turnover is lower in this cycle, right? So I'll come back to asset turnover. And third is equity multiplier. In this cycle, as we have shown in previous Netra, one of the best features of this cycle is deleveraging. Corporate balance sheets are very, very strong. You can go back to our July publication of DSP Netra. You will find a quilt where it shows that balance sheets in India are very, very strong. And this is an outcome where companies have not taken too much leverage. And secondly, they have also diluted a lot of equity. So by diluting equity, the number of share goes up. So in the formula of return on equity, the denominator goes up. And therefore, if you look at it, of the three components, net profit margins at all-time high, very, very good. Asset turnover, not so good. Third, equity multiplier, not so good. When you look at all these three factors, you'll find that ROEs have not gone up. Now, why asset turnovers have not gone up? This is again a very important question. For that, you can think about it in two ways. One, because consumption growth is slower than the previous cycle, 2003 to 8 cycle consumption growth was, the nominal growth itself was 12 to 14%. Okay, in this cycle, the nominal growth has been 10% or so. Secondly, private consumption was growing at 15% plus CAGR. In this cycle, it is 7% CAGR. And all these are nominal numbers, right? And when you look at these numbers, companies will foresee and they will look at their own demand numbers and they will see that the demand CAGR is, or the sales CAGR is not more than 10, 12, 15%. Why should they do additional capex? Why should they do sweating of assets more? And therefore, asset turnover falls. And they want to run the same capacity at a lower rate so that the costs are in control and profitability is high. And this is one of the reasons why any market which trades at premium valuation is very, very vulnerable to low nominal growth. And I think this point is very, very critical, very important. Very few people understand this, that it has been shown in the past in previous markets. A lot of markets have showcased that markets where there is a very strong growth. For example, the Japan of 1970s and 80s, the nominal growth is very high, and suddenly valuations reach a very, very high multiple and nominal growth goes away. A lot of people believe that profitability itself will be able to generate enough returns so that multiples can sustain. But that is not the case. Nominal growth is very, very important. And if you go back to some previous Netra editions, we have actually shown that over the last 20 years, all of the PAT growth in India has come from sales growth because margins have been more or less stable across cycles, right? So right now we are at peak margin, which is a very good outcome, but it is already in the past. In the future, can we continue to have peak margins? I don't know, right? Let's assume even if you have peak margins, ROEs are low, and there is no sign right now that these our asset turnovers are going to go higher. They will go higher if businesses see more demand, they do capex, and the whole cycle follows through. It can, of course, happen with various levers, but given where we are in the cycle, we are susceptible to slow nominal growth translating into slow earnings growth. That is very, very important. Second point is that what is the source of the high ROE or high ROE or high premium multiple for India, right? So India trades at a premium to all emerging markets, and a lot of people have also repeatedly said that this is one reason, that India continues to be an attractive market. But what the question is that why is this premium for India? Where does it come from? So we put these sectors which have continuously showcased very high return on equity multiples. You can see out of the heavyweight sectors which are marked in blue, there are a few sectors like FMCG where ROEs are 40% plus. In fact, the average ROE since GFC, you can see 45, which used to be 60. This number is skewed because of HUL's GlaxoSmithKline acquisition. If you remove that, the ROE for FMCG sector continues to be at that record level. IT ROEs have actually improved. Automobiles ROEs have more or less been stable. Oil and gas ROEs, X of RIL, have increased. So there are these sectors which have repeatedly given India a premium multiple, right? And when you look at the earnings growth for these particular sectors which are responsible for India's premium valuation, the earning growth for all these sectors have declined. Now think about it that the key driver of our premium multiple, those sectors themselves are facing headwinds, right? But still India continues to be at a premium. Why? Right? So if our sectors which are responsible for India's premium valuation, there the earning growth has slowed down. Although valuations have not come down so much, they are still down compared to their own history, but not so much, right? Uh, what is the reason for India's premium valuation to continue? One very simple reason is that cyclical sectors, for example, you can look at constructions, you can look at metals and mining, construction materials, all these sectors which are cyclical in nature, you can see that they have started to trade at multiples which are very, very high compared to their own history. In fact, some of the sectors are trading as if they are FMCG companies. Case in point is some stocks which are from, let's say, the defense sector, where 80 to 90% of their revenue comes from only one customer, which is Government of India, and they trade at 40, 50, 60 times multiple, right? And and their ROEs are also not very high compared to the FMCG sector. Their ROEs are inferior, but because of the narrative, because of the growth that we've seen in the last 4 or 5 years, these sectors have got re-rated very high. Now the question is that every time cyclicals get very high multiples, they are prone to correction, right? And why? Because cyclicals disappoint. It is in their name only. They are very cyclical. Their business models are cyclical. Uh, Largely think about it this way, particularly in the case of commodities. There is a very generic statement called the cure for high prices is high price, which means that the moment prices go up, commodity supply comes back, prices fall, margins for these companies fall, and therefore they're cyclical in nature. As of today, many sectors in India which are cyclical are trading at high multiples, and they are probably responsible for a stretched history of higher multiples in India. And usually, investors who are value conscious, who look at sectors very closely, they will go back and see where the margin of safety lies. So basically, they will go back and flock to high quality sectors where the earning growth has currently slowed down, and wherever there is valuation multiple, valuation comfort coming back, they will flock to that space and try and not be too much in the cyclical, right? So the conclusion for the last two slides is that multiples in India have been high, driven by very high ROEs. Those high ROEs, which were very high in 2003 to 8, in this cycle has peaked at a lower level. So in 2003 to 8 was 20% plus. This time they have peaked at about 15 to 16%. And the reason India continues to have high premium versus other market largely stems from high quality sectors. But in this cycle, even low quality, low ROE sectors are trading as if they are high quality sectors. But all of us know that they are not. It is just a cycle, and each cycle brings its own new winners and losers, and this cycle will not be different. Next is that one more very important and pertinent question. Think about if you divide India's uh, corporate listed universe, you will find that out of 100 rupees, almost two-third or 70% of top line sales growth is influenced by global commodity prices or exports. Okay. And this is a very large number, although in profitability it will be closer to 50%. But if you divide this universe, and you will see that export-led sectors are facing their own headwinds or growth challenges. Domestic sectors are also facing challenges because nominal growth has slowed down. So when you look at this slide on your screen, you will find that nominal growth in FY26 started at sub 9%. In FY25 also it was sub 10%. Okay. Now the question is that when you have nominal growth at 10% or so, and global export growth is also less than 10%. In fact, it is less than 5%, right? Let's say you add back inflation, you get a 8-9% reading. Where will the 20% earning growth come from? That is what the market is pricing in right now. How does it price in 20% earnings growth? By trading at multiples of 25, 26, 27 times. In fact, mid and small cap median multiple is still close to 40 times, right? And that is how the market is pricing in a rising profit margins, which is very, very hard to foresee how it is possible. Second, earning growth of 20% plus. Once again, there are no indications where this earning growth will come from. And therefore, when you look at these factors combined, there is a case to be made that multiples will derate in India. And we've been saying this for 1 year now. Multiples have not derated. Market has not done anything. It has only gone through a time correction. We have no clue how the future will unfold. Whether market will continue to have a time correction or it will have a price correction, we have no clue. One thing is clear that when you have such high multiples, margin of safety gets eroded. The next slide is on the rupee. And there is no rupee chart, of course, in this slide. It is on India FX reserves. What we have shown is that the 5 year CAGR of FX reserve accretion in India has fallen to a very low number of 5%. Right? Earlier, the worst period that we had was 5 year CAGR at minus 1.8% back when in 2013 to 18, when we had the trouble of twin balance sheet problem. We are entering sort of that zone now, right? And it is very surprising that when our CAD is 0.2% and inflation is at a structural low, is where foreign inflows are not coming. And we have in many past issuance shown you why this is the case. Why foreign money has not flown in and led to this huge problem of foreign flows. And we believe that this is an outcome. What you see in terms of FX reserve and also a trouble for the rupee. And it does seem that the new low on the rupee continues to be a very, very important point. And I have noted down this in this slide that ignoring a multi-year low or a new low on a currency is a big mistake. Why? I would want to explain that to you. So in the currency market, there is a very, very large, what we call a 1,000 point gorilla in the market. Who is that? It is the central bank. Any currency is usually has a very large player. For example, in US, it will be the Federal Reserve. In Eurozone, it will be the ECB. In India, it is the RBI. When you participate or you have a negative bet on a currency, you are also standing against the central bank because all central banks wants to maintain the purchasing power of their currency. And the reason is that if the confidence in a currency is eroded, it is very, very hard to get it back. And therefore, ignoring all-time low on a currency is a big mistake. All-time low do not come very easily, as I told you. For India, it has come at a time when our external situation on paper still looks very, very good, and which is a conundrum, right? And we've showcased in the last edition of Netra and many editions prior to that at the beginning of the year also that many factors that drive our external trade, for example, exports, they have negatively surprised. For example, remittances, they have sort of peaked out. For example, software exports, they have slowed down, right? Many of these aspects, which are very, very important for our international trade, they have become less positive or they have become negative. And therefore, we think that pressure on the rupee could continue in the short term, and which will probably be a negative or a very important point to monitor going ahead. The next is a sort of early signal or which we note from time to time, slightly a differentiated point from the first 3 points that I've noted, that the small and mid cap momentum factor or the momentum factor itself is completely driven by the small and mid cap universe as of today. So you can see the very high correlation between small and mid cap stocks and the momentum factor currently is in the 37th month of continuation, which itself is now the highest that we have seen on record. The last time was 36 months continuous, which was back in 2008 or January 2008. It peaked out. It continued for a while and then peaked out. So what we are seeing is that momentum factor performance largely is coming from small and mid cap stocks, and also that this is the segment which is more expensive than the large cap. And therefore, when the tide turns, which probably it already had last year, and we are in sort of a zone where this reversal is taking place, the momentum factor may not be the best area to participate in the fashion that it is practiced today. So investors who are participating here should be very careful. Large caps, even for momentum, could be a much better place to be. The next section is about tariff, gold hoarding, and gold mining. And this is a section which now has gained a lot of prominence. Um, I think back in 2022 and 23, when we were writing about gold miners and gold itself, um, there were not many takers because the past returns were not very high. But now we are seeing that numbers have started to flow in, and a lot of people have become interested. But once again, investment decisions should be taken based on the merits of the data that we have rather than on what other investors are doing or saying. I think it's very, very important to look at the hard facts before we make our decision. So we look at them. First is the tariff impact. You can see that tariff impact is now beginning to show up in data. Tariffs are now at a 100-year high. This is the chart that we made back in Jan or Feb Netra, where we highlighted that the way Trump is projecting tariffs, they can go to 100-year high. Now it has become a reality where tariffs are at a 100-year high now. This is very clear. Historically, we've seen these high tariffs usually lead to a global slowdown, and whether this time it will be different or not, we don't have a clue. But we think that it is a big, big threat. And what is a bigger threat? I will show in the next few slides that trade wars are usually they start as bilateral wars, but they eventually morph into multilateral wars, and will look at that. But that is a big risk. Second is that the promise that US administration did was that they are going to deploy tariffs and achieve two goals. First goal was that they will bring back manufacturing to US. Second is more recently they have said they will use tariff revenues to reduce their debt. Okay. So now you can see that in the left hand scale, this is the big jump in tariffs that you can see. So some um, reporting will happen which will say that tariff revenue in US has gone from 5 billion a month to about 30 billion a month or 25 billion a month, an increase of 500%. It's very possible that you will read a headline like this. But this is actually what the rise is all about. You can see this like a flash in the pan. It doesn't do anything to US finances at all, but it does cause a lot of trouble globally. It can cause a lot of global slowdown because it creates friction in the global economy, right? So, in fact, we think that tariffs eventually will do nothing to cure the US fiscal imbalance, but it will, of course, cure US trade balance, which is the channel through which it will cause growth slowdown. And I think some part of it is already happening with dollar already weak and US trade deficit. I think by the end of December, we'll start seeing it in numbers that trade deficit in US will start declining. It's only a matter of time, and it will become a channel for reduction in global growth. This is India's cut on how much do we export to US and what are the tariffs. You will note very carefully here if you look at it, sectors like chemicals, leathers, here the tariffs are more than, so for leather and leather products, more than 50%, for chemicals, 24%, engineering goods, 38%. So these are the sectors which are very large and they also have very high tariffs. And electronic goods does not have very high tariffs, which is mobile phone exports. But in totality, according to our understanding, out of about 87 billion, one third is susceptible to very high tariffs, and therefore those sectors will get hit. But on the face of it, it does appear that US tariff on their own may not be materially negative. Okay, unless they are applied to the IT companies. Of course, we'll talk about that when we come to the IT section. But for now, US tariffs alone may not do significant damage. What is more harmful is the prolonged trade war. Why? Because the more it lasts, there is a very high likelihood that other countries will also put tariffs on each other. That's why we've written here that trade wars are seldom bilateral, they often morph into multilateral trade wars. So you will recollect that just last week, Mexico has highlighted that they are interested in putting tariffs on other countries, right? And this is not surprising. The moment these trade negotiations create 15-20% tariffs, 15% tariffs today uh, sound like a very good deal, but it is not, right? If that tariffs becomes a new reality, then these 15% tariffs will not only between US and other trade partners, it will actually be between partners also, and it will have a very big impact. It will create and reset a lot of supply chains, and therefore our fear is that this bilateral trade war should not turn into a multilateral trade war. If it remains what it is today, the impact on Indian economy numbers will be small, but 50% tariffs in these particular sectors will be negative for these particular sectors only. Broader economic impact will be smaller, but once again, that is not the end point. The end point is that they end up morphing into a multilateral trade war, and which is what the big problem is. The next is when we talk about gold, and we looked at this data historically, whenever there has been a gold hoarding, where people hoard a lot of gold, or a price bull market, it has been followed with some kind of an economic event. Now, one reason could be that whenever money flows to gold, it goes into less productive asset, which is gold, and goes out of the economy where more capex or productive expenditure would have been done, and therefore this leads to some economic crisis eventually. That could be one reason, but we are not entirely clear. But historically, it has shown that shrinkage of money supply, because a lot of money flows to gold, has caused recessions in the past. But now we are in not that kind of an economy. We are in a fiat money system from 1917 on 70 onwards. But still, gold's rise sentimentally showcases the nervousness for financial assets, and we've seen that repeatedly happening. This time we saw the COVID crisis, whether it was the last one or not, we are not entirely sure. Does it indicate that there could be more economic pain ahead? It's quite likely. The next is we've highlighted a phenomena called the gold put. Okay, this will also tell you our viewpoint on gold. It's very clear that we've been positive on gold, and I've highlighted repeatedly that there is no reason to second guess the bull market. It has continued. It will have its own stoppages. It had a 3-4 months of no returns. Gold was consolidating between April, May, June, July, did nothing. And then we had one more up move. And the reason is that this is a very unique bull market. Why? Because all the factors which support gold prices, for example, the dollar, real rates, inflation, etc., nothing is extremely favorable, right? You can see we did a factor analysis. Almost all factors are against gold right now. But the big gorilla is the central bank buying, and central banks have been buying gold left, right, and center. And I have named that phenomenon as gold put. Why? Because central banks, when they purchase gold, they are not very price sensitive. Unlike an institution or an investor or a trader who will think about buying gold, for example, at 3,000 or $3,010, right? Central banks issue mandates. Those mandates are carried through by bureaucrats. For example, if a central bank will issue a mandate to acquire X tons of gold, it will give an indicative date and time window and ask the people who execute to purchase that amount of gold. They will not be too price sensitive because it is a national decision. And second, they need to diversify away. And we have highlighted in the past also that confidence in US dollar has reduced. A lot of country wants to diversify away from purely dollar assets, which is the US Treasury, to other assets, and there is no better alternative than gold. And therefore, you see repeatedly strong central bank buying. In fact, in first half of 2025, central banks have again bought 410 tons of gold. Last 3 years, they bought 1,000 tons plus. This year, projections are they might buy 800 tons plus. They've already bought 410, right, in the first half. And we'll see the numbers whenever they come. But at 3,000 plus dollar, think about the dollar amount they're buying, it continues to be a very high price. So, what is gold put? Gold put is that there is a downside protection to prices which is being provided by the central bank buying. And is it continuing? It does look like it is continuing. And as long as the US administration is using tariffs and other threats versus other countries are more aligned to purchase non-dollar assets. And currently, there is no better non-dollar assets than gold. Even I think Indian Finance Minister has highlighted that RBI has started to diversify its FX reserve towards gold. So very large central banks, RBI is a very large central bank. China and many other Asian central banks have also clearly shown their affinity towards gold. And this is the put, which is it protects the downside because central banks are buying gold where the price sensitivity is low, and therefore they bid up the price rapidly. And also remember that gold is a market which is still in a deficit. This slide is on gold miners, and we made this slide almost 2 years ago, last year also, where the numbers were much lower when miners were underperforming and they had just started to inflect. Now they are outperforming uh, S&P 500, and even gold is outperforming stocks. So there is this double positive which has happened for miners. Of course, they had a very large rally. Can they correct or see a sideways consolidation is quite possible. But one thing is very clear that gold miners are now enjoying profitability, which is at the highest level that we have ever seen. We don't have data from 1980 because mining was not very organized at that point in time, but we do have the data from the first bull market, which happened from 2000 to 2011. Current profitability trends are almost double of what they were back then, and valuations are roughly half. Okay, so that is how I think about it. It's very hard to remain positive on a sector which has doubled or more than doubled in less than 1.5 years, but numbers are still aligned. In terms of profitability, the trends are still intact. Gold bull market is also still intact. So I don't think there is any reason to rethink about this and maybe possibly just hold on. The only red flag is the valuation. Valuation multiple, which were dirt cheap maybe 6 months ago, are now just average. And remember that this average multiple is also because last 10 years were very, very bad. So this is the average of the worst phase, and we are back to that average. So you can maybe make an educated guess that maybe this average is misleading and therefore valuations are still okay. But and there are a lot of future projections. If you go by future projections, gold miners are cheap. But the problem is that we don't believe in future projections because the reason is that we do not know the future. So it is much better to look at the trailing numbers and maybe err on the side of caution all the time. Even if you take that into account, it still makes sense to have some holdings in gold miners because of the profitability that they are showing and the underlying dynamics. One proxy for gold miners which have come up in last 1 year is silver. And historically, we've done some data analysis and we've seen that in outright bull market, silver behaves like gold miners. The multiples become very, very aligned because it also enjoys a very high beta versus gold in bull market. And we made that point repeatedly in the past that silver is a better bet. We showed you gold silver ratio also and also presented a number of other arguments. And now it has more or less started to play out. We still think that silver has a much longer way to go from where it is right now. The next section is on technology, which I think is very, very important. And we have presented a very, very important aspect. So a lot of people have in the past seen that technology is a low capital intensive sector, which means that you do not need a lot of capex. But in the last 5 years, the large tech companies of the world, Apple, Microsoft, Meta, Alphabet, Amazon, all put together have done almost $1 trillion in capex. Now, this is $200 billion more than oil and gas companies, which are very, very capital intensive, which means that they need a huge amount of capital expenditure to put plant machinery, rigs, and whatnot to just get oil out of the ground and sell it, right? Or also do exploration, etc. These companies, AI companies, are now, or other technology companies, are spending a lot of money on buying chips from specifically from NVIDIA and some other vendors and doing this very large capex. So we have two doubts. One is that what is the output that we are creating for this $1 trillion capex? Now think about it this way: that if you do a 100 rupee capex, you need a payback period, the years in which you will make that money back. So if you are doing $1 trillion capex in AI, what is the revenue that you should generate from this capex? And that revenue will have a profit margin, and that profit margin should repay this capex. Currently, the thought is that AI capex will create a revenue stream like the software. Maybe, for example, like an iPhone or like a Windows, right? And it will also be so profitable that it will be able to pay it back very, very quickly. As of today, those numbers are not available, right? So all the companies which are doing these AI capex, they don't have the profitability in that segment to showcase that this AI capex is creating sustainable financial profitability. What is visible is that companies which are benefiting from this capex, like Nvidia, right? And their profit margins are upwards of 70-80%, and they are making a lot of money, which is also the question number two, that when oil and gas capex happens, the economy benefits. How? You get oil out of the ground, it creates use case for energy. Handful of oil in an automobile powers lot of things, vehicles, tractors, and it creates economic wide benefit. All the AI capex that we are doing is powering what? And this is the question that investors should always ask when they are paying multiples like 30, 40, 70, 100 times, right? What is the output generating today? So today, it's a debate, right? When you speak to some people, they will say that they are creating path-breaking innovations and technologies, but what we are not sure what they are, right? You will hear about a number of phrases like productivity going up through the use of LLMs, uh, some gamers beating others. You will also hear about great outcomes in medicine, etc. But when you think about a product from AI or a tangible use case that all of us are using for the last 2 years, you will still struggle to find out one, right? Which is creating a profitable outcome for the company selling it. And therefore, we think that this number has gone too far. AI capex has reached a level which is very, very high. We showcased in the last DSP Netra also, it is now 1.2% of US GDP, a very high number. Even oil and gas peaked at about 1.5% of GDP. And therefore, we will wait and watch and see what is the output that it will create. The reason for that is that the market is now giving it a market cap which is very, very high. So in US, the market cap for these companies has reached about $30 trillion or so, a very high number. In MSCI ACWI index, seven other sectors, which is consumer staples, energy, material, utility, real estate, consumer discretionary, industrials. If you add all these sectors together, their market cap is equal to the technology sector. This has never happened in the past. It happened once during the dot-com bubble that everything else became a dwarf in front of the technology sector, and we are seeing that happen once again. But this time, the difference is that the technology sector has the profitability to, command this market cap, which was not the case in dot-com bubble, right? But the question is, can that profitability continue, right? Specifically for not for the broader technology sector, but at least for the AI companies. And I think we have our doubts on that, but we will be happy to see it unfold and see this sector grow. But it comes with a lot of cost. And therefore, I think it's a red flag for us, and we'll see how it pans out in the next 2 to 3 years. The next is that many of these companies that are operating at very high ROEs. You can see Apple has a 157% ROE. We were talking about Nifty ROEs of 15%. You can imagine what a 157% ROE means. Microsoft at 33%, Alphabet at 33%, Amazon at 24%, Nvidia at 119%. You can see these ROEs, Meta at 37%. And these ROEs are also after doing a huge amount of capex. They are doing a huge amount of reinvestment, right? And when you look at these numbers, you will note that the reason for these companies to have these very large ROEs comes from backward integration where they have compromised on the profitability of their vendors. You can see very low ROEs of most of the vendors. For example, for Apple, Foxconn, 32% of cost of goods sold comes from Foxconn. Foxconn is the main vendor, where the ROE is just 10%. Operating margins are just 3%, right? So all the profitability that you see in the technology is coming from somewhere else. They have created that model, and therefore investors should think about that in the current scenario where these linkages which got formed in the last 20 years, if they are breaking, can these linkages continue to provide this profitability to the big tech, big AI companies? I think that these things are getting reset as we speak, and therefore some of the tech companies which are enjoying very high multiples at very high market capitalization levels are seeing attack from two sides. One, very high capex and little revenue to show for that capex. And second, the ROEs that they enjoy because of the cost savings that they are doing, they can also get challenged. And therefore, I think it's a very important time to rethink about this space. Now we come to Indian IT, which is diametrically opposite to what the global IT is doing. And why is that the case? Because Indian IT has spent nothing on AI or any modern technology, which has been a negative point because of some analysts. Some analysts have pinpointed that they've been left behind. But in some sense, if you think it in a different manner, think about a company like IBM, which did spend nothing on AI now in the last 5, 7 years, and has now enjoyed huge amount of profitability because it did not spend anything, right? So maybe that company comes out on top when AI capex story unfolds. But anyways, in the Indian context, most of these companies have also now seen their valuations decline significantly, right? They are yet not bargains, right? Indian IT companies are not bargain buys. They do not have absolute margin of safety. What they are starting to have at the large cap level, very few names, is a relative margin of safety. Companies, for example, very few people will realize that companies like TCS are now trading at 3.8% dividend yield, right? Which is unheard of, right? Multiples have come down now. 3 to 5 year returns are lowest. They have underperformed the broader market. Their weightages in Nifty are at 10-year low, 15-year low. And therefore, it tells you that from a relative perspective, what is a relative perspective? That these sector may do same or better than the broader market. Uh, but it does not mean that it cannot fall. So if the market falls, this will also fall, but there is a possibility that it may fall less. And it will also approach the margin of safety much faster. And therefore, some opportunity can come up in this space. Very, very selective, and therefore investors should look at some of these offerings which have IT in them. Uh, this is the last slide, which shows you that when you mix assets, for example, equity and gold mixed together, it reduces your portfolio volatility, largely because equities have very large negative skews, which means that they have days when they fall drastically, while gold has large positive skews, which means that there are days when it goes up significantly. So these two, when mixed together in appropriate amounts, makes a more robust portfolio than any one trick pony. So I think this is it from my end.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.